Using discounted cash flow analysis to make investment decisions. This is Chapter 9, Part 1. Following are the expected learning outcomes from students. Following this chapter, students should know how to prepare cash flow estimates. Students should do an analysis of net present value. Students should compare and contrast cash flows with accounting income. Here is the net present value rule. We should be able to forecast, in the first step, the cash flows. In the second step, we should be able to estimate the opportunity cost of capital, R, which is then used as a discount rate in the denominator. In the third step, we will compute the present value using the discount rate or the opportunity cost of capital. And when we take the difference of the initial cash outlay with the inflows that give us the inflows that arrive in the future, or the present value of these inflows, then we can calculate the net present value. Now, first thing to realize here is that accounting income is not equal to cash flows. Suppose there's a project that costs us $2,000 now. The cash flows emanating out of this cash flow our project are $1,500 at the end of year 1 and $500 at the end of the second year. We use a straight line depreciation in accounting, but the actual expense itself is immediate because we have to pay for the project right away. Now, the accountant's perspective is that in the year 1, the cash inflow would be $1,500. The allocated straight line depreciation is $1,000, and the accounting income, therefore, is a difference is $500. Now, in the second year, the cash inflow is $500 from here. The straight line depreciation gives us a cost of $1,000, and the accounting income, therefore, is negative $500. So if we discount these cash flows and find out the NPV at 10%, then we will see that the net present value is actually $41.32, which is not how a financial manager would look at this project. How a financial manager looks at this project is, I spend the cash at time t equals 0. So the year 0 cash flow is minus 2,000. The year 1 cash flow is 1,500, and the year 2 cash flow is 500. We take the net present value of these cash flows at 10% and find the net present value is minus 223.14. So whereas the accounting numbers tell us to not reject the project, the cash flows from our financial perspective tell us to reject the project outright. So let's keep asking the question, should we go ahead with the project? Now, the first step in making a decision like this is consider the incremental cash flow. So if we consider the incremental cash flow, what we mean by incremental cash flow is we should forecast the firm's cash flow if we go ahead with a project. Now, if we go ahead with a project, we should compare that with, suppose if we had not gone ahead with the project, how does the firm's cash flows look like? And take the difference of the cash flows A minus B if we went ahead with the project versus if we did not go ahead with the project. We should also not fail to include indirect effects. We have to include the indirect effects. By itself, a trip might be a loss, but if we include the indirect effects, then the trip might just be positive. For example, a trip from Peoria or a new flight from Peoria to Chicago might not be able to produce those kind of revenues which make the flight itself sustainable. But there might be a lot of customers who give additional incremental revenue out of flights from Chicago. For example, a person might want to go from Peoria to New York. So they would be taking a Chicago-New York flight. So the Chicago hub gets an additional flight from Peoria because of the Peoria-Chicago flight. So the indirect effect of the Peoria-Chicago flight is a Chicago-New York passenger. Next, we must include the opportunity cost. Now, by that, what we mean is the benefit or the cash flow foregone by undertaking the project. For example, if you have a piece of land and decide to build a factory on it or a construction project, then we are foregoing the income of selling that piece of land for some money. So that is the opportunity cost lost. So Maybe we sell this piece of land for $100,000, and the opportunity cost of new project, therefore, of constructing an office space or any project on this land is therefore already minus $100,000, the opportunity cost. The next step is we must recognize that we have to initially invest in working capital. Initially, when the project starts up, it drains our working capital, and as we unwind the project, it adds to our working capital. Finally, there's terminal cash flows, which come at the end of the project. We must know the terminal cash flows. If it's scrap, then there are cash inflows of selling the scrap. If it's environmental cleanup, then the cash outflows of cleaning up, of let's say a gold mine. There will be terminal cash flows of cleaning up the gold mine or the pollution caused by the gold mine. And finally, we have to beware of allocated overhead costs. Now, the question that we need to ask is, let's say, for example, in the case of electricity, if I need to pay for electricity or rent of the premises, even if I'm not carrying out my new project, then the overhead cost is not directly attributable to the project. So it is not incremental cash flow. Incremental cash flow means that the new project will produce these cash flows. So we have to be aware of allocated overhead costs. Now, this is a question. Would the cash flow still exist if the project did not exist? And if the answer is yes, the project would still exist. The cash flow would still exist if the project does not exist, like an overhead electricity cost or the rent of the premises. We should not include this cash flow on the overhead or rent into the incremental cash flow because of a project. The next part is we must compare the nominal versus real cost of capital because there is inflation. Now we know that the real rate of interest is 1 plus nominal rate of interest divided by 1 plus inflation minus 1. So the real cash flows, if we use real cash flows, then we need to discount it by the real cost of capital. If we use nominal cash flows, we have to discount it by nominal cost of capital. Now here's an example. Suppose we use nominal cash flows. So for example, we have years 0, 1, 2, 3. Our cash flows are $8,000 every year. And we find out the present value at 10%. Now 10% is the nominal rate of interest. And 3% is the rate of inflation. Now suppose our cash flows are growing at the rate of inflation, which means that the time t equals 0, there is $8,000. So the present value of 8,000 is 8,000. At time t equals 1, my real cash flow, the actual cash flow will grow at 3%. So 8,000 times 1.03 or 8,240. The second year, my cash flow will grow at 8,240, which is 8,000 times 1.03 times 1.03 or 8,000 times 1.03 squared, which is 8,487. The third cash flow similarly grows at another 3% to 8,742. What's happening essentially here is that the issuer has told me that they protect me against inflation by increasing the cash flow at the same rate as the rate of inflation every year. So when we need to find out this present value, we have the actual or the nominal cash flows of 8,000, 8,240, 8,487, and 8,742. We have to discount these actual cash flows by the actual rate of interest or the nominal rate of interest, which is 1.1%. So the first present value is 8,240 divided by 1.1, 8,487 divided by 1.1 squared, and 8,742 divided by 1.1 to the power 3. Add these up. This is my present value at 10% for this project. However, if I were to use the real rates or the real cash flows, which is 8,000, 8,000, 8,000, and 8,000 at the end of years 0, 1, 2, and 3, then I have to use a real rate of interest. How do I get the real rate of interest? Well, I do 1.1 divided by 1.03 minus 1, which gives me 0.068. So that's how I get this 6.8%. So 8,000 divided by 1.068 to the power 1 is 7491. Divided by 1.068 to the power 2 is 7014. Divided by 1.068 to the power 3 is 6568. So these are our real cash flows. This is our real rate of interest, but the present value at that rate of interest is the same as the present value on the previous slide. which is when we use the actual cash flows and the actual rate of interest, 29073. 29073. In the next session, we will see capital cash flows, operating cash flows, and the causes in change in working capital. We'll consider a single large project to end this chapter. That's chapter 9, part 1. Thank you for listening.